Well, let's talk now to someone who believes that the issue of inflation has been ignored by investors for too long. He's Valentijn Van Nieuwenhuijzen, Head of Fixed Income and Economics at ING. Welcome. Thank you very much for joining us today. It's interesting, inflation has been something in the UK that we keep being told not to worry about. It's pretty high, but don't worry. It's too high, but it'll be okay. You're actually saying the opposite. You're saying actually the worry is that it might go too low.
Absolutely. The UK is kind of a special case, but I think that the UK is sensitive to general trends that you see in the developed world, where actually we're still having massive output gaps that tend to depress underlying trends in inflation. So headline inflation, driven by indeed food and energy prices, is a bit high. And due to the weakness in the currency, you see this in the UK specifically. But the underlying current in inflationary trends is clearly still downwards.
No. Is it the case that investors have been very concerned about major things, the credit crunch, then the economic slowdown, the worries of the economic slowdown coming back, also concerned, of course, about the sovereign debt crisis, and simply inflation is something that hasn't really been on the radar?
Well, I wouldn't say it hasn't been on the radar. I'm actually a bit worried that on the back of the sovereign crisis, on the back of central banks being very aggressive in their policy stance, basically cutting rates to zero, that investors anticipated sort of out of a gut feeling that it would lead to a burst in inflation over the next 2-3 years. And actually, I don't think that is very realistic. The monetary transmission mechanism isn't functioning in most of the developed world. And as I said, there's basically, due to a lack of demand, excess capacity available in all economies, and that depresses the influences on inflation and the underlying current. So actually, I think the risks of inflation are overestimated and the risk of deflation is actually higher than excessively high inflation. Are
we already seeing evidence of this trend?
Well, I mean, the worrying thing is that specifically in August, you saw that inflationary expectations in the treasury markets were coming down. We're not seeing it in the survey yet, so that's a positive thing. But you see that core inflation rates globally have come down to 1%, well below the central bank targets. We're seeing that inflation expectations in the markets are coming off. So policymakers should really be fighting the risk of deflation to prevent us from getting stuck in some kind of a Japan scenario. And we've all seen in Japan what that can do to an economy.
Indeed. If we look at the Japan model of deflation or stagflation, do you think that that is the kind of thing that we could genuinely see? I mean, if you take into account all the BRIC economies and I mean, there are an awful lot of differences between the one single country and indeed a global model. Is it a global model that you're thinking of?
Well, I don't think it's the global model. I think there's a lot of differences still. We've been more aggressive on the policy side than ever happened in Japan. Balance sheets in the private sector are more healthy, although some are still troubled, but they're more healthy than they were in Japan in the 90s. So I do not expect a Japan scenario, but I think the risk for policymakers to not fight it more aggressively is a big one. If there is a new negative shock to the global economy, whether it's oil prices, terrorism, or something else, just a negative shock, then this scenario could materialize, and therefore policymakers should preempt this risk and run the risk of somewhat higher inflation rather than run the risk of getting stuck in deflation.
Now, you say preempt it. What specifically could they do?
Well, of course, that's the whole debate now. I mean, can we do more QE? Will it be effective? It's questionable whether it will be effective. What they certainly can do is be cautious with too aggressive fiscal tightening. And this is a risk that you see emerging in many countries. What they should do is address the long-term fiscal issues to do with healthcare, to do with pensions, but at the same time be cautious to aggressively tighten policy over the next 12 months, because the global economy is still too fragile to digest that.
It sounds like this is something you're aiming more at the European countries who are in the middle of austerity measures rather than the US, which is, hasn't really got there yet.
It is true. It is true. They are in the middle. But remember that with the elections coming up in the US, it seems quite likely that actually the fiscal stimulus will turn into a negative for growth in the US next year. Even if the Bush tax cuts, which are bound to sunset at the end of this year, will not be expired, then still the contribution to growth from fiscal policy will be negative in the US and probably more negative than in Europe. It's quite remarkable, but that's the case.
So what should institutional investors do to protect themselves against these concerns?
Well, they should at least understand that extremely low interest rates in the treasury markets are not necessarily the same as arguing that the only thing they can do is rise. That's yields. Compared to where money market rates are, there is still quite an attractive risk premium in treasury markets. So I think they should understand that it's not a one-way bet in the bond market, and that actually bond markets are still offering nice risk premiums and should be part of your portfolio.
Okay. Thank you very much indeed for joining us today. Thank you.